Right now, we are witnessing a massive, honestly, almost unprecedented migration of wealth happening in the US stock market. It's this fascinating shift, a true tale of two markets, really, and it's actively reshaping the entire financial landscape right before our eyes. So let's unpack exactly what's going on in this explainer. It's literally the biggest paradox in finance right now. Why on earth are tech stocks plunging, but the broader market just isn't crashing? I mean, by all normal logic, with tech bleeding this heavily, the sky should absolutely be falling. But the overall market is holding its ground. If you're trying to make sense of this, you are definitely not alone. To figure out the why behind all of this, we're going to break the data down into 5 key areas: market divergence, the tech burden on the Nasdaq, the S&P 500 struggles, the Dow Jones acting as a safe haven, and finally, cash flow trends. Let's jump right in. Starting off with Section 1, market divergence. The biggest takeaway right now is that the market is absolutely not acting as a single unified entity. Instead, the data is showing us a massive, rapid capital shift between major sectors. You see, investors aren't fleeing the stock market in some blind panic. They're just aggressively and very strategically rearranging their portfolios. It's like a giant puzzle where the pieces are moving in real time. That brings us to Section 2, the tech burden dragging down the Nasdaq. The selling pressure mounting in the tech sector is just palpable. The Nasdaq 100 has taken a really sharp dive, dropping all the way down to roughly 27,800 points. It's officially become this heavy anchor on the entire market ecosystem, and it's seriously dragging down overall sentiment. To put that plunge into perspective for you, the index actually evaporated by a staggering 2.85% in just the very first session of the week. I mean, that is a massive chunk of value just disappearing almost overnight. So why exactly is this happening? Well, the data points to some real exhaustion in big tech. That relentless hype train around AI and semiconductors, yeah, it's finally cooling down. This isn't some random terrifying panic sell-off. It's active, deliberate profit-taking. Huge capital flows are simply locking in their gains after what was a wildly overheated bull run. Structurally, this puts the Nasdaq in a highly precarious position. It is dangerously close to its one-month bottom. Because of the heavy distribution at the previous peak, meaning large institutional players aggressively selling off shares to secure those profits, the index is really teetering. If this immense selling pressure keeps up, analysts are eyeing a further slide down to a 27,625 target. Let's look at Section 3, the S&P 500 struggles. This aggressive tech sell-off is actively squeezing the broader, more diversified U.S. market. Sitting right around 7,415 points and down about 1.35% from the previous session, the S&P 500 is completely failing to maintain any upward momentum. It's dragging its feet in the lower zones, weighed down heavily by its exposure to tech. Structurally, it's basically caught in a trap. It's stuck right in the middle, kind of pinched between this heavy resistance at its one-month peak and some pretty weak support at its one-month bottom. The market is trying to hold its rhythm, but without tech pulling its weight, it's locked in a really frustrating sideways struggle. And when we compare the VIX, often called the fear gauge or volatility index, against the S&P 500, the forecast remains quite pessimistic. As volatility spikes, the expectation is that the S&P 500 will likely just continue its downward trend, searching for solid ground in even deeper zones. Now for a pivot in Section 4, the Dow Jones safe haven. Just when you think the entire market is bleeding out, we find our unexpected hero. It's literally being hailed as the brightest star, going against the market trend. While tech plummets and the S&P 500 just struggles sideways, the Dow Jones Industrial Average is completely defying broader market gravity. No joke, it's wild to see. Despite taking a 1.1% dip in the U.S. session yesterday, the Dow rapidly and impressively regained its strength. It surged to hit 52,630 points, seamlessly filling its opening gap for the week as if the tech sell-off wasn't even happening. The structural contrast here is massive. Unlike the Nasdaq, which we know is scraping its monthly bottom, the Dow is anchored right up near its one-month peak. Its structure remains highly optimistic, and its momentum is incredibly robust right now. Finally, let's wrap up with Section 5, cash flow trends. We know the Dow is up and tech is down, but where are all those billions of dollars actually hiding? Well, the data clearly maps the money. Large institutional funds are abandoning that frantic tech race and pouring their capital directly into defensive havens, value stocks, banks, healthcare, and heavy industry. These are the traditional pillars that offer stability when the high-growth sectors falter. So the smart money isn't just cashing out and hiding under a mattress. It is aggressively rotating. The big players are playing defense, securing those massive profits they made during the tech boom by sheltering them in traditional, stable industries. They are actively choosing safety over speculation. Which leaves us with this final, critical thought. As you analyze this massive capital shift for your own portfolio, you have to ask yourself, are we just seeing a quick, necessary breather for tech before it surges again? Or are we witnessing the dawn of a massive new era for value stocks?